This is the best performing HPAL asset in the world. It performs at over 100%. So all these things really make us one of the most important, if not the most important, pure play on the TSX for nickel. So if an investor wants to express a nickel view on an asset that is producing and has a 7-year track record of production, this is the only one.
But it's a kind of erratic commodity, certainly in terms of the pricing, right? So why is it going to last any longer this time than last time? Hello and welcome to our viewers on cruxinvestor.com, also to our listeners on Cruxcast, a podcast series. We're here today with the guys from Conic Metals. We've got Anthony Milewski, we've got Martin Vydra.
Thanks a lot for having us back.
Thank you.
It's always a pleasure.
It's been a while, and we saw each other back in June.
Yeah, it's been a few months.
Yeah, so you've been pretty busy, but we're now in the nickel space. Wanted to talk to you today about where you think nickel's going and maybe help people understand the future of nickel, because it's a fairly erratic metal, or has been, these sort of super cycles, but I think people are quite excited about this EV revolution and what nickel's going to do.
Yeah, it's definitely, I think, the most exciting time nickel's really seen since really the big China build out over a decade ago. And what's driving our interest in nickel is really the evolution of the battery chemistry. And just to kind of remind people, when we talk about batteries for electric vehicles and also for stationary batteries, in large part you're talking about a nickel manganese cobalt chemistry. And depending on the battery type and use today, you're probably looking at a 5-3-2 mix of chemistry, 5 being nickel, the cobalt, and then you've got the manganese. And what's happening is we're transitioning towards a battery which is ultimately going to be 8-1-1, meaning 8 parts nickel, 1 part manganese, 1 part cobalt. And frankly, in the coming decade, it will probably transition even further. And so as we see this electrification thematic rollout, not only with cars, but also with battery storage in general, as it pertains to the lithium-ion battery, you're going to have a huge crunch on the nickel market. And it's really a specific type of nickel that's used in batteries. And there are 2 nickel markets today. There is a ferro-nickel market, which is effectively your steel industry. And then there is a second nickel market, which is really the nickel that goes into chemicals, batteries. And so it's an interesting time. And actually, it's a confusing time because the nickel run that we're seeing today is actually not driven by electric vehicles at all. It's actually driven by, in part, regulatory situations in Indonesia and some buying out of China. So on the one hand, we're getting all this excitement around nickel, but it's actually not the excitement that we're playing on, which is this future demand that we're seeing coming from electric vehicles.
So you guys have come out of the royalty and streaming. Obviously, Cobalt 27 was royalty and streaming business. Conic Metals, royalty and streaming business. Obviously, Cobalt did what it did. There was, it kind of spiked, came back down again. For whatever reason, the market. What was the reason?
Yeah, look, there are really 2 simple reasons why that happened. I think the first one was we saw destocking in China of cobalt inventories, and simultaneously with that, we saw a huge spike in artisanal supply out of Congo. And there's a lot of conversation around that, but I would say some of that is tainted with child labor and some of it isn't. And so you had both of those things happen simultaneously, and you took cobalt from $44 all the way back down to $12. Now, ultimately, the outlook for cobalt is still incredibly bullish. It's just that over the next couple years, the market needs to work out ethical sourcing. It's a major, major issue with cobalt. It needs to work out how to handle that artisanal supply as the demand comes in. So, we're still bullish cobalt. We still have cobalt exposure in each of our royalties today and our joint venture interest. It's just that, from our perspective, nickel over the next few years is going to be a more liquid market, a deeper market, and a market probably more impacted ultimately by the demand that's coming.
Right. Okay. So, let's talk about this now, because thank you for the explanation about the nickel market, and people need to either get behind that thesis or not, and then make the investment decisions as to whether nickel's something they want to get into, and perhaps we can get into a bit more detail further into this conversation. But Cobalt 27 had a sort of tumultuous rise, rapid ascent. You built that up into something quite meaningful, but mainly based on the price of cobalt, right? And it came back down. So there were some difficulties which you foresaw. And is that what drove the move to Conic Metals with Paula? I mean, what was the thinking behind it? What's going on in the head there when you made that decision?
Yeah, ultimately we didn't make that decision. I mean, shareholders, and in particular minority shareholders, made the decision to sell the company. The reality is that we had declining liquidity, and Paula Investments came in and bought 20% of the company and put an offer to shareholders. That wasn't the plan from the outset. That's the way it developed. And I think sometimes it gets lost on some of our shareholders, in particular some of the minority shareholders, that they ultimately are the ones who sold the company by voting for it. And so the transition to Conic was driven by that sale. We were always building a nickel position. Inside of Cobalt 27, it may have been as high as 40% of the NAV was nickel. So we've always had this view around nickel, and you can even see that in the acquisition of Ramu, which is really, in the first instance, a nickel stream, and then in the second instance, a cobalt revenue source. Right. So we've always had this view, but in particular around the acquisition, that was really driven by an investor who came into the market and purchased, and then they got put to shareholders, and they decided to sell. Right,
but the board made a recommendation to you guys where you did your assessment. In fact, you got independent assessment, as I read. So, but you recommended that the sale happened.
Yeah, well, we recommended putting it to shareholders. Ultimately, as a fiduciary of the company, if someone brings a premium bid to the board, and you're in a declining market, and it had been declining for almost a year at that point, I really believe that you need to show that liquidity to the shareholders and let them ultimately make the decision. Right. So that was recommended to shareholders, and they were able to make a decision as to what they wanted to do with that liquidity, and they chose to sell.
Okay, but you guys did quite well out of it as well.
Yeah, no, right. we did.
So, but that, I think people will accuse you of saying, well, it was in your interest, not say shareholders' interest. I mean, how would you answer that?
Yeah, look, I think you learn as you go in this game, and one of the things I would do differently is, and will do differently, is structure compensation differently. So, we used a very traditional Canadian compensation structure that was disclosed from the IPO on. It never actually changed. And I think, going forward when structuring compensation, I would probably try to come up with something new and novel, which directly links ultimately the performance of the stock or the performance of the exit in a way that aligns maybe a little bit better management and shareholder returns, which is not actually the case for the standard contract in the Canadian public markets. Yeah. And so I think one of the criticisms, rightly so, is okay, you guys made money and a lot of people didn't. I think if I was to start over again, I would, and which we are in Conic, kind of create a structure where it's more aligned, so you don't have that outcome where there's a perceived idea that one group is making money and another isn't.
So I mean, I read through a lot of the 596 pages.
It's a small book,
right? Yeah. It's all detailed there, so people know what they're getting into, or should, if they read it, know what they're getting into. But if you don't mind, in summary and brief, how have you structured it for the new entity with regards to
It's not been structured yet.
It's not been structured
yet.
Okay.
So there definitely is not a structure in place yet. And what I would note is notwithstanding the criticism, ultimately we took a large percentage of that in Conic stock at $1.96 kind of share price, and I think it's going to probably open at 40 cents. So, we tried to kind of better align our interests with our shareholders, but ultimately I think you go all the way back to the beginning, and if you could see the end from the beginning, you would structure it completely differently.
Well, sure. I mean, we'd certainly avoid a lot of misunderstanding in the marketplace, but again, I would say to investors, retail or institutional, you've got to read those documents. You know what you're getting into, and you can vote with your feet, right?
Well, but frankly, on that topic, really, the contract that we had was the standard Canadian contract. It just sort of worked out that way, and so I think it's not simply just reading it, it's also deciding if there's a different model that works better, or if there's a different way of approaching it.
Yeah, and that's probably a topic for another day, because I think we have this conversation a lot about directors' remuneration. And I appreciate there are standards, but some of those standards need to be kind of held up to the light, I think, a bit more in a lot of companies with a lot of CEOs. But it's a conversation for another day, and I understand. Thank you for explaining that. So looking forward, Conic Metals. You're trying to you've spotted the nickel opportunity here. Also we've interviewed quite a few nickel CEOs. Got another one coming in after this. The future looks bright, but it's a kind of erratic commodity, certainly in terms of the pricing, right? So why is it going to last any longer this time than last time?
Well, I think first of all, Conic, when it launches, will be probably the largest investable nickel pure play on the TSX.
Okay.
But that's not to say that some of the large miners don't have exposure.
Largest in what way? How are you measuring
It's a pure play. Well, the way I measure it is the other alternative is share it. And Moa Bay is a great mine, but there are a lot of investors who are restricted to invest in Cuba. So there are a lot of U.S. investors who can't invest in Cuba. So once you move away from that, we're kind of the only producing nickel story out there that's a pure play. And I think how many tons of nickel do we do a year? We do sort of.
Well, Ramu produces 34,000 tons a year. We have almost 10% of that.
Right. So this is a major operation, and I think it's going to be really interesting. The nickel companies that are public, by and large, reside on the ASX. So it's a unique opportunity for Canadian investors to get exposure. Now, as to price, this move right now is, as we said earlier, is really about Indonesia and also a Chinese entity buying some material. This is not the big move, and frankly, it's probably going to go a little bit harder, but we will see a pullback. The move that is driven by electric vehicles, I would say, is still a couple years out. This move right now is not to be confused or conflated with the EV move. And so I think there could be some euphoria that could drive some valuations in a place where they go only to be disappointed. Yeah. And I think if we learned anything from Cobalt, you don't want it to go too hard too quickly and then cause a lot of problems on the downside. And so what I would caution investors is that right now this is not being driven by electric vehicle demand.
Great. You're the first person that said that. That's fantastic. Because I believe it.
Yeah, no, it's factually the case.
Absolutely, right? And I think people need to take note of that. So that says there's a second wave potentially, which is also good news. It's all good news for nickel, it would seem. But what are the lessons you've learned from Cobalt? You mentioned lessons learned, right? So the Cobalt was going to take off, next big thing, batteries, etc.
Well, Cobalt is still the next big. I mean, Cobalt is still going to be big. I promise you.
But there was a wave, right? And so what have you learned from your time at Cobalt 27, which you're going to apply to Conic, right? Because, like you said, you learn stuff as you go along.
Yeah, right? I think one of the things, which may be unexpected, I think one of the things in particular that is important for Conic is the development of a retail shareholder base. Okay. So in Cobalt 27, we had a lot of capital raises in a short period of time, and it was a heavily institutional stock. And primarily a lot of these were big hedge funds who were chasing the EV thematic. And as quickly as the EV thematic was in vogue, it went out of vogue and they kind of moved on to whatever the next tech story was. And we didn't have the underlying share register and shareholder base to absorb that move out. Right. So I think one of the things that's important in Conic is to spend a lot more time helping retail shareholders get comfortable, understand the nickel story, and ultimately invest. Which is ironic because a lot of times what you probably see are guys with a bunch of retail shareholders and no institutions. Yeah. And I think what we're saying is that's important. Yeah. But I think developing that retail network is going to be really important this time. Right. Because actually, and I'll tell you, this was an insight that I had at Cobalt 27. Retail shareholders are actually the biggest source of long-term shareholders. That's important, and it's an important insight. Most of the capital today is really on a 12-month cycle. That's the way they get paid. It's just the way the world has gone. They're in pods at Millennium, whatever the case might be. And so the nature of that money is it's shorter term, and it's driven by macro factors. Sometimes guys have to sell because an internal desk tells them because the risk premium went up. But fundamentally, and this was one of the big lessons learned, was retail shareholders actually take a 5-10 year view sometimes. And so courting them and helping them understand the story is very critical, I think, to what is, of course, going to be a volatile story because of the nature of electric vehicle adoption and the macro and all these other things.
So, and what else in terms of the business model?
Yeah.
Have you learned? Okay, so that's on the financing side and the financeability and the liquidity and volume and so forth. In terms of the model, you're a streaming royalty company. Have you got that? Did you have that bit correct at Cobalt 27, or was you
No,
going to come at it a different way?
I think we know how to do deals. I mean, I think that's one thing we're probably not going to be criticized for. We did plenty of deals. In fact, we might be criticized for doing too many deals.
Yeah.
So I think we understand that, and in fact, in Conic, we don't anticipate doing any deals anytime soon because there's so much value to unlock in Ramu, and Martin can speak to that later. But really, this is the best performing HPAL asset in the world. It performs at over 100%. In terms of like the nameplate capacity. And so, what's really important in the coming months is to get that story out and let the shareholders find what I view as tremendous value in the stock in the coming 6 months.
Okay. Martin, hello.
Hi.
We've not met.
Yeah, nice to meet you, Matt.
Yeah, thanks for coming over. So, Ramu.
Yes.
What is it?
So Ramu is a HPAL, high pressure acid leach operation that was built by MCC of China in Papua New Guinea. It was commissioned in 2012 and it's been operating since that time, and over the last 4 years it's been operating at above nameplate capacity, as Anthony said. What's really important, Matt, is since 1996 there's been less than a dozen HPAL operations that have been designed, constructed, and potentially failed. A lot of them are not running anymore. Every single one of those projects exploded on the capital budget, and none of those projects, with the exception of Ramu, is able to run at the original design capacity. None of them have ever achieved that. So we have an asset here that is not only one of the best HPAL assets for treating laterite ores to make a form of nickel that can go into the steel industry if we want, but is also highly sought after by the battery industry, so there's flexibility. It's also one of the best overall performing assets in the world. There's some third-party publications that measure performing nickel assets globally, and there's typically 70 that they measure. And there's a line consistently called the bottom quartile for cost. Ramu is consistently within that bottom quartile. So that gives us an asset, as Anthony says, that we've got a long life there, we've got resources there beyond 20 years, we've got a great partner operating it. We're in a very good jurisdiction. If you look at some of the other jurisdictions globally, PNG has a great relationship with Australia, PNG has a great relationship with China, we have a great relationship with them, so we're just looking forward to unlocking, as Anthony said, a lot of that value. Okay,
fantastic. Now I want you to deal with actually something you talked about, was this sort of ethical mining in DRC, Congo. There are some stories in the marketplace with regard to deep sea waste being deposited by the Ramu project.
Right.
What do you know about that?
So I can tell you that all HPAL operations generate a non-usable byproduct.
Right.
It's typically an iron oxide, and it could be acidic. What Ramu does, though, is they neutralize their waste to pH 7 and 8, which is the same pH as the ocean. They have a fully permitted, fully licensed deep sea tailings management system, which means that they are allowed to discharge that solution at pH 8 well into beyond any reef, any coral, into the deep ocean. All other HPAL operations have some sort of license of this. We've had this license by the PNG government. We follow the strict adherence on that. We have it independently audited. We inspect the pipeline every 5 years thoroughly, and we do an annual inspection on the discharge, and we've never exceeded or broken the rules that we are operating under. So anybody who says, you've got this issue, I'd like to see some facts, because the facts I've seen has shown me that we have not exceeded or been outside of the bounds of our tailings management permit ever.
And that's all independently verified?
All independently verified. We do have people there now that are working with the Chinese operator because we want to get the facts out.
Okay.
So, yeah, and I think that's important. A lot of the media was completely inaccurate. I mean, the thing restarted last Friday. But no one, Reuters isn't writing about that. Where's the article? You write this sensational article, and then everybody forgot to follow up. So I just think that it's an easy target because it's in a place where a lot of people haven't been. It's with an operator that people don't know the management. So it's kind of low-hanging fruit for journalists to write some irresponsible articles because simply factually weren't true. So it's
kind of interesting. It's come out. I'm not taking a side here. I'm just pointing out that I was sent a clip by an Australian TV broadcaster where protesters were outside a mining conference in Melbourne. stopping mining executives getting into the conference. I mean, it was pretty violent in places. A lot of police deployed, arrests made, etc. Do you think? And I think we talked about this last time. Was about the ethical mining and the misconceptions or conceptions in the marketplace where people get very passionate about their views. Now, some of it based on facts, some of it not. Do you think what's the mining industry going to do about that?
There's no question.
Right?
The biggest kind of talking point, you saw Rio Tinto last week, the biggest talking point in mining right now is ESG. Yeah. It is the biggest talking point. But something that your listeners and everyone needs to appreciate is, like, look around the room you're in. Everything you see is basically mined or grown. And so long as we as a society, as a global society, are going to continue to consume, we're going to continue to mine. So I don't think the conversation should be around should we mine or shouldn't we mine. The conversation should be about how do we mine ethically, how do we do it in an environmentally friendly way, or at least in a way that's friendly enough to sustain the environment, because mining is not going away unless consumption is going away.
I hear you. So the question and discussion is around the ethics of it. You've answered me very clearly, Martin, and said we followed every single guideline, permit, license that we're obliged to, and we will report back on that, and it's independently verified. Okay, so that's great. You're not necessarily investing in anything coming up or buying anything soon, but you will do. So the ethics is still a big part of.
Let me give you an example. So the most interesting junior, I think, in the world in nickel is Turnagain. It's owned by Giga. Okay, Turnagain is a couple billion tons. I personally bought. Just to
declare that.
For full disclosure, I think I've bought up to 4% of it now with my own money. It's in British Columbia. It's carbon neutral, going to be completely ESG compliant. It can be operated with electric vehicles. It's completely green. It will be fueled by hydroelectric power. And so one of the reasons that we like it is that it checks every ESG compliance box. I don't know, Martin, you've actually spent a lot of time on looking at that. I don't know what your view of it is.
Yeah, so for disclosure, I'm a director of the company too, and I'm also a large shareholder.
And we interviewed them, for full disclosure, we interviewed them 3 weeks ago.
We actually bought our shares. We literally physically bought them. There's no free shares. We bought these shares because we believe in it.
Yeah. So in terms of ethical mining, Anthony hit it on the head. When you look at, if I'm going to invest in a new nickel project, do I want to invest in an HPAL project that's going to be on the ocean, that I'm going to have a lot of issues with locals about what do you do with the tailings, what do you do with the mining, things like that? Or you can look at a massive sulfide deposit in British Columbia, and Anthony said exactly, we have access to hydroelectric power, so we kind of say, well, there's no CO2 generation there. We're looking, and in the future, all mining companies are eventually going to be using electric-powered mining fleets, so you're not going to get any CO2
or hydrogen
there.
Or
hydrogen. But the third thing that we discovered with the Turnagain property is the silicate residue. So when you dig up the ore and you separate the nickel from the residue, some people call it tailings, but it's residue. The silicate residue is actually a CO2 sink in its absorber. Excuse me. And this has been proven at some other mine sites in the world that have realized that their residue is absorbing CO2 from the environment. So doing Turnagain right, we will actually be a carbon sink, not an emitter. So we will be able to sell carbon credits under the Canadian system as a byproduct. So I think to young retail investors looking for, I want to buy my EV and I want to know that the energy I'm getting from it is green, but I also want to know it was produced in a green way. We can say, listen, the nickel and cobalt in your batteries came from this mine, which has 10-to-1. And this mine is a zero carbon footprint mine. What do you think of that?
So this is really exciting. And it kind of comes back to this whole thing around ESG investing. And one thing which is important about nickel, and really, if we talked about cost curves ultimately drives nickel price, is one of the best ways to destroy value in mining since at least the 80s has been, frankly, it's been building nickel mines. Like Ravensthorpe. How much money did Valley blow at Gora? How many $1 billion?
Murrin. Talvivar.
And we're talking billions of dollars. So
Goro.
And this is because of HPAL, right? It's very hard to dial in that process. And so what's interesting about Turnagain is it's a sulfide, so you can actually build it for $500 to $700 million.
Right.
And so that's interesting and exciting, and it kind of goes with this whole thing around ESG that we're huge proponents of. I mean, personally, we've talked about this before. I'm an environmentalist. I mean, I love the outdoors. I love getting back to nature. We go to Alaska every year and spend time in the wilderness. So this is something which is also close to my heart, and I feel passionately about, first of all, the need for mining, because in fact we live in a world that consumes, but the need to mine in an ethical way, not only for the environment, but for also the local people that live in that area.
Okay, I hear you. So, but let's kind of bring this back to you guys, because I think we've kind of segued off there into a few other companies. But who else are you invested into at the moment? What are they? Because we talked about the various royalty streams.
You're talking
you've
about
got.
So Conic, we have a royalty on Turnagain, which is Giga, and we have a royalty on Dumont, which is really owned by Waterton, which is a private equity firm.
Yeah.
I think 80% or something. So those are the two main ones, and then we have a couple in Australia, which are probably earlier stage.
Right. Okay.
And those are both, to be clear, they're royalties. So we have the nickel and cobalt exposure.
Okay. So looking forward in the nickel market, you've explained that kind of quite clearly to us. What are the companies that you think, just to get a bit of your insight about the market, what are the companies that you think are going to be worth investing into, which you don't have shares in?
Okay, so look, I think the answer is it depends on what spot in the market you're looking at. Clearly, like if you look at Independence Group in Australia, or even Norilsk, but Norilsk has some other exposures. Those are bigger, more liquid names.
Yeah.
And for me, whenever I like a commodity, I like to own a basket, and I take an approach of having some very liquid names, some kind of intermediate producers, and then some small caps. So if I was constructing a portfolio, I would own some Independence and some Norilsk. And then, on the kind of that end of it, Independence moving down into the mid cap range. I would own nickel mines in Australia. They've been very successful in getting started, and you can see that in the share price. And then moving down, I would actually own Giga for Turnagain. And personally, I like Sherritt. There's a lot of torque there. So it's really sitting under a mountain of debt. But that nickel price runs, and they start repaying that debt. So just as a retail investor, that's potentially interesting. You need to be a little bit careful because some people aren't allowed to own that, but that's each person has to check that out. But I would actually own a basket. I don't personally ever like owning a single name. I like owning kind of a handful of names that have leverage to a given commodity.
Okay. Thank you. You agree with that?
Yeah, I do.
Yes.
My own personal view, though, too, because of my technical background and thorough knowledge of the market, is I would also look to some other names that are either very close to production or in production, and the asset is a high quality asset. So there's a couple other there that Anthony didn't mention, but we're pretty much aligned. So there's a couple other assets. I really like the Talvivaara mine, which is owned by Terrafame in Finland. I think that mine is operating very well. It took a long time to get it going, but it's also quite environmentally friendly. And I like some smaller assets. There's one in Brazil called Brazilian Nickel, which is experimenting with a heap leach. They're at a demonstration scale. I think they have a good thing going too, and it's an interesting play, and I'm watching them very closely to see where they end up.
Okay. Horizonte, do you know them?
I know the name, Horizonte, yes. They've got a couple of projects in Brazil.
That's right. That's right. No views?
I looked at one of their projects over 20 years ago.
No current views.
Let's skip that.
Yeah.
But 10 years. Okay, so let's finish up with Conic, just in terms of some of the numbers. Okay, you've had, up to $48 million of debt wiped out.
Yeah, there's no debt on the company.
So no debt, right? And then you've got $5 million to play with. Now, you're not making any acquisitions. You're not really doing too much on that front. But $5 million it's not a lot of money. But is it enough?
I think it is. I mean, first of all, we're all shareholders. I think management owns 8 to
8 or
10,
9%.
9% of the company. I mean, I think our interests are highly aligned with shareholders' interests. Right. The last thing we want is any dilutionary capital raises or anything like that. So I think that's the first aspect of it. The second aspect of it is the G&A is not really, it's a small team. It's Martin, myself, Justin, and Connor. And then in Australia we've got Craig and one other person. So it's a very small team.
Right. What is the G&A going to be? Do you know? Have you got any sense of that yet?
No, but I think the $5 million lasts us years.
Years.
Years with an
2
S.
years.
Couple years.
Couple of years.
Yeah.
Okay.
So and maybe 3. It just kind of depends, right? So, but what we foresee is we never really had time to tell the Ramu story to the market, and so very quickly after that deal closed, we got into this situation around the bid in the market, and now I think it's time to really help everyone see the value. You know, once we're able, we're going to buy more of it because we just believe that, you know, we believe that even if you book it at cost, meaning the cost that we paid for it, so the cost that Cobalt 27 paid for the asset in a lower nickel environment, you know, we're still a double from here. That just gets back to kind of where we paid for it. And nickel's moved materially, so we think that the value is actually much higher than that. And so it's really our job to get that out, help people understand any of the questions they have around the production, around environmental, around the country. And you know, that's what we're going to be doing over the next kind of 6 months.
But do you think that's going to be enough? Because obviously, you know, you did the deal with Cobalt 27. People have taken a big chunk in cash. They got given shares at I don't know what price. Can you remind me?
Well, effectively, the deal closed and the share price on the last tick was $4.40. And they got $4 of cash. So the implication is that on day one the shares will trade around 40 cents. Right.
Okay. So again, there are people who were shareholders who voted, or even if they didn't vote, they're sitting on some stock of Conic, and either they're going to dump it quickly or they're going to go on for the ride because they think there's something in the nickel story, right? So that it's all obvious stuff. What are you planning on doing? Because you've got the royalties, you've got the assets, you've got. How do you?
Yeah, what's it? I mean,
more than just tell the story.
The next big moment to unlock value is really around cash flow.
Right.
And you know, historically, there's been so the way that it works is that when Ramu was being built, the underlying company lent money at the joint venture level to fund it for Highlands. And so there's a non-recourse loan that sits there that's sort of paid out of cash flow.
Right.
And as soon as that loan is paid down,
when's that?
You know, that loan, if we don't do anything, takes 2 years probably. Okay. If we do nothing, okay? And if nickel price stays flat, if it goes up, it's faster, right? Yeah. So our job is to bring forward cash flow by creatively paying down that loan, or what has historically been the case is negotiating a cash split, such that you know, maybe only 70%, I'm just making up a number, right? I'm not guiding anyone here, but a certain percentage goes to paying down the loan and a certain percentage comes back. And in that way, you can immediately start talking about a dividend or a share buyback.
Right.
So I think unlocking value is really around that asset and bringing it into free cash flow, bringing the top co, Conic, into free cash flow positive.
Okay, so it's an interesting point there, right? So what do you guys do while you're sitting around for the next 2-3 years, not buying anything, not doing deals, which I know you're good at, but you're not doing deals. Yeah. So what are you doing? You're doing things like we'll restructure the debt repayment per portion.
We're unlocking. I think the key to unlocking tremendous value, one is telling the story because no one knows the story. That immediately will re-rate it. And the second thing that can be done immediately, and by immediately I mean these things take months, but relatively quickly, is figuring out how to unlock that cash flow, because now you are free cash flow, and you can completely transform the company. And I think that's where you can really unlock.
What does that mean, and how long does that take? I mean,
historically it's been the case. Right? Historically, Highlands has had that split.
Yeah.
So it's really, we have not been able to even have that conversation for 7 months while we've been inside of this deal.
Right. Okay. So they still retain a small portion of this going forward, do they?
Who?
Highlands.
No, we own Highlands.
You own it 100%?
Highlands is our subsidiary.
Complete subsidiary. Okay, fine. So what are those conversations you have internally to say, hey, we need to unlock some value for shareholders? I mean, great. We're going to renegotiate a bit of debt. We're going to do what? What do you do for the next 3 years?
But we're not talking about 3 years. We're talking about like what happens in the next. Well, look, the balance sheet looks completely different. Okay. Like now, when you have free cash flow, your balance sheet is not one that requires dilution to do anything.
Got it.
Right? Like, I mean, just by way of example. And by the way, you know, at today's prices, that, and if it goes any higher, I mean, that loan gets paid back dramatically quicker. And also, I think one of the things, and this is not to skip around here, but people don't understand is today, you know, the joint venture interest is around 8.5%.
8.5.
As soon as that loan is paid off, we actually go from 8.5% to just over 11%.
Okay.
So the interest actually expands, and that cash flow wall that comes in is significant and material. And you know, even in a worst case, that happens in the next 24 months, hopefully, right? And so that will completely transform the company once again. And there's tremendous optionality around this, right? So in addition to those things, probably 3 or 4 years out, there's an expansion at the mine site, which we have the option to participate in. So all these things really make us one of the most important, if not the most important, pure play on the TSX for nickel. So if an investor wants to express a nickel view on an asset that is producing and has a 7-year track record of production, this is the only one, right? This one, or I should say Sherritt. Like those are the two, really. And Sherritt, by the way, has an oil and gas business and has a bunch of other businesses. This is all we have. And so that is unique. And I think in the face of a nickel tape that only gets more interesting in the coming years, like we're going to be an alternative for, in particular, Canadian investors.
Interesting. Okay.
And I think just to answer your question, one of the immediate things we do is we engage with our Chinese partner on a much deeper level now, because for the last 6 months, as Anthony says, we've been focused on this transaction. We closed the Highlands transaction at the end of 2018, and then almost early into 2019, this transaction hit the table. So, as a small team, all of management was working on this. We now have the opportunity to sit down with our Chinese partner and engage with them on what do we want Ramu to look at? How do we leverage the fact that we are the best HPAL operation in the world? How do we make that better? How do we leverage the fact that we're not getting our nickel or cobalt from the Congo? You're here. And the fact that battery producers want our product and actually are looking to pay a premium for it. And they actually look to us because being a Chinese business, they're quite integrated through some of their operations that they've never operated outside on a global scale. And Cobalt 27, Conic, we bring to that the fact that, listen, we have a team that's got global presence. We're here at LME Week. I'm actually leaving from here, going to China and meeting with them, and then we'll all be back there again in December. So that's the first step, is you got to get your Chinese partners engaged, which they are, understand what we want to do, and then they will support that movement.
Okay, so again, I find that kind of interesting. So you think you can do things which Highland wasn't doing before?
I think we can bring more options in front of the Chinese, which Highlands didn't have the opportunity because Ramu was still in a late ramp-up stage, early stability stage. So over the last 2 years, Ramu has absolutely demonstrated the phenomenal track record. And Ramu was just starting to enter that period while Highlands was still in control.
And also Highlands, you wouldn't know the history, but prior to us doing a deal with them, funny enough, they actually had a big shareholder. Someone tried to take them out. One of the trading houses partnered with someone else and made a run at the company. And so, they had a year where management was completely distracted and they ultimately prevailed and were able to fend it off. But, the story has not been told. And Highlands, and to be fair, they were under the gun there and were unable to tell the story as well. And so it just needs to be told, and it hasn't been told. There are definitive things, like Martin said, that we can do, but actually it is important just to have people understand the asset, because this isn't a lot of the stories. I watch your interviews. A lot of your stories are talking about a someday mine. Mm-hmm. No, this is going to be producing for 40 or 50 or 60 years, and it's already producing. Mm-hmm. And so this is an operating business.
Yeah, we do interview a lot of someday mines. People, Giga being one of them, where we're trying to understand. Retail investors are trying to understand who to believe, who can get there, who is just going through the motions, etc., etc. And you made a few points today about portfolios and what type of companies, etc. So I do appreciate that. I think that's a great reintroduction to your business. I wish you well for the future with Conic. Lovely to meet you as well, Martin.
Nice meeting you.
There's a lot of good things in there. I'm sorry some of it was dealing with some misconceptions in the marketplace, should I say. But I think we'd love to kind of stay in touch. Tell us what's going on as things progress. As you start telling this story, I'm sure we'll meet again.
Yeah, thanks for having us as always. It's great to have you.
Appreciate it.
Thank you very much.
Thanks very much. Thanks very much for watching. We hope you enjoyed that. And if you did, please click the button in the corner of the screen to subscribe to our YouTube channel. You can also catch us on our website, cruxinvestor.com, and Cruxcast, our podcast series. Plus, most days you can catch us on LinkedIn and Twitter. We'd love getting your feedback, so please keep that coming, and we'll speak to you again soon.